Banking conditions in the 9th District in the first quarter of 2013 were slightly weaker. Hi, my name is Ron Feldman. I'm the head of Supervision, Regulation, and Credit at the Federal Reserve Bank of Minneapolis. And today I'm going to be talking about banking conditions in the 9th District as of the first quarter of 2013. And the overall message is that conditions were flat to slightly weaker. So first I'm going to give an overview, and then I'm going to give you a little bit more detail on each of the points. So first, just a reminder as to what is the 9th District. So the 9th District consists of Minnesota, Montana, North Dakota, South Dakota, the western portion of Wisconsin, and the upper peninsula of Michigan. So what are the messages for this quarter? Well, first, as I mentioned, conditions were generally flat to weaker. So we follow three main measures of condition. First, we look at the problem assets that banks have, and these are, I should say, banks that are headquartered in the 9th District. Then we look at the profitability of banks. And finally, we look at the loan growth, year-over-year loan growth associated with those banks. And in each of those areas, we saw a slight weakening. Putting it in a slightly broader perspective, asset quality as a whole, that is problem loans relative to the financial resources that banks have to absorb those problem loans and problem securities, are at a historic low for the last 20 years. In contrast, profitability and loan growth remain weaker than what they've been historically. And then the final point I'm going to make is that what's true for the district is really true for virtually all of the states. That is, there were slightly weaker conditions. Now, it still remains that some states have stronger banking conditions than others, and in particular, the Dakotas are quite strong, but they weakened a little bit too. So now let me go through each of these points in more detail. So first, let's talk about problem assets. And as you can see from this graph, problem assets were generally flat in the first quarter. And by, again, problem assets, we're talking about either loans or securities that are not paying on time or not paying in full. And what we do is we compare the amount of those loans and securities to the financial resources that banks have to absorb losses. That would be their capital and what's called their loan loss provisions. You can see that despite the fact that these were flat, they remain at historically strong levels. How about profitability? So normally in the first quarter, profitability rises relative to the end of the year. And here we could actually see that profitability declined. And while it's only one quarter, that's an unusual phenomenon and something that's worth paying more attention to. So what's the source of the decline in profits? So the first thing that we're going to look at is what's called provisions, as you can see in this graph here. So provisions are monies that banks put aside to absorb losses that they expect to have in the future. Now, normally when you see provisions fall to the level that you see in this graph, you would expect profits to rise. Why is that? When you're putting less money aside for the future, you take more in earnings today. So how could it be that banks actually saw their profitability decline? Well, let's go to the next chart. And here you can see it's because of a very substantial decline in the net interest margin. Now that sounds like a fancy term, but it's actually pretty straightforward. What we're looking at here is the difference between the amount that banks earn on their assets, so for example, the interest that's paid on the loans they make, relative to the costs that are involved in making a loan. So for example, the cost of paying depositors, the interest that they earn. The difference between the two, or the spread, is the net interest margin. And you can see that that fell considerably. And that's really important because for most banks that are headquartered in the 9th District, this is going to be their main source of income. So this is something, again, it's only one quarter, so we don't want to overstate the importance, but this will be something that we'll be watching going forward. We also see that there was a decline in loan growth. There remains positive loan growth, so year over year there's more loans on banks' balance sheets than the year before, but the rate of the increase was actually less this quarter than it was at the end of last year. And you can see from this graph that not only has it declined, but that it remains at relatively historically low levels. So to summarize, for the district as a whole, we saw generally flat to weakening conditions, which is a little bit unusual for the first quarter. How about for the individual states? Well, I'm not going to go through every performance measure, but generally speaking, it's going to look a lot like this graph here that's showing you what problem assets look like for the various states. So there's two panels. The upper panel, which has got the graph in the red, is showing you states like North Dakota, South Dakota, and Minnesota, where their performance in problem assets is better than the district as a whole. The bottom panel in blue shows you those states that are weaker. So for example, Montana, Wisconsin, the Upper Peninsula of Michigan. And what you can see is that the Dakotas continue to remain much stronger in asset quality, and the same would be true for profitability and loan growth than the other states in the district. Nonetheless, for this quarter, their performance actually got a little bit worse. So what I said about the district as a whole generally applies to all the states, although the relative positioning of the states remains the same. So let me sum it up. So the first quarter is normally a quarter where we see improved loan growth, improved profitability, and even some improvement in asset quality. This time around, we didn't see that. It was a quarter that was a little bit weaker. We don't want to make too much of one quarter, but it's something that we're going to keep our eye on as the year develops. Thank you very much.